Good morning, dear friends. I am DC Agrawal. So many good words have been spoken by Taxmann for us, but then we are one of you. You are practicing, we are practicing, and we are serving the taxpayer public. So we have written a book on capital gains, which has been recently published by Taxmann. We will talk about a little later. Now we are required to, in fact, introduce you about various changes that have been made by Finance Act 2023, which relate to capital gains. So, we have prepared a PPT running about, 30 sheets or something. So, one by one, we will try to explain most important changes that have taken place by Finance Act 2023. So, I will first ask my dear colleague, Mr. Sanjeev Dutt, to take up 2-3 chapters out of it, and thereafter I will talk about other chapters. So, I hand over the mic to Mr. Sanjeev Dutt. They will start with the different chapters which are initially in the PPT. Over to Mr. Sanjeev Dutt.
Thank you, sir. Very good morning to all the friends who are taking part in this webinar. As the sir has said, we are going to take up about half a dozen items of the agenda in which some changes have taken place by virtue of the Finance Act 2023. I'm sure most of you would have already familiarized yourself with the changes or amendments which have come through the Finance Act 2023. But today, we will only deal with about half a dozen items which are there in the agenda today. So before we get into our serious business, we'll just begin our webinar on a lighter note. And as Sir has explained, what we are going to do is, I will deal with the first 2-3 items of the agenda, and then I'll pass on the baton to Agrawal sir. So let us now start our first item of the agenda. No, perhaps this item is not there, but we'll discuss it since this amendment has taken place in the Finance Act 2023. These are the two newly inserted sections, 4720 and section 49(2)(ai). They provide for exemption from capital gains on transfer of interest in a joint venture by a public sector company in exchange of shares in a foreign company. But the purpose of this exemption seems to be to facilitate the process of disinvestment of public sector companies having joint ventures with foreign companies. So what are the main features of these two provisions? First, there is a transfer of a capital asset representing an interest in a joint venture. Such capital asset is held by a public sector company. The transfer of interest takes place against allotment of shares in the foreign company. And this foreign company is incorporated outside India by the government of a foreign state in accordance with the laws of that state. So this transfer under 4720 will be a tax neutral transaction. No capital gains will be charged on such transfer. Joint venture, the expression joint venture has been defined as a business entity as notified by the central government in the official gazette. And section 49(2)(ai), the newly inserted section 49(2)(ai) provides that cost of interest in the joint venture shall be deemed to be the cost of acquisition of shares acquired by the public sector company in such exchange. Let us now move to the, this is the first item on the agenda. Taxation of conversion of gold into an electronic gold receipt or vice versa. So we all know that the government has introduced this scheme of a gold exchange. The idea is to operate a gold exchange by virtue of conversion of physical gold into digital gold or an electronic gold receipt. So what is an EGR? EGR is a form of depository gold receipt which can be traded on the stock exchanges. It is an electronic receipt issued by a SEBI registered vault manager against the gold deposited with. So we go to the vault manager, deposit gold with it, and against that gold, we will be issued an electronic gold receipt, which can be traded on the stock exchanges. So as per amendment made in explanation 1 below 242A, a new clause HI has been inserted, according to which now we come to the holding period of physical gold and the EGRs. In case of EGR issued in respect of gold deposited as per section 47(6)(d), 7D, period of holding of physical gold by the assessee prior to conversion into EGR shall be included in the period of holding of EGR. Similarly, when this EGR is reconverted into physical gold, the period of holding of gold will include the period of holding of such EGR prior to its conversion into physical gold. So these are the two changes which have been made. A new clause 47(7)(d) provides that any transfer of a capital asset, being conversion of gold into EGR issued by a vault manager or conversion of EGR into physical gold, shall not be treated as transfer for the purposes of section 45. Thus, on conversion or reconversion of conversion of physical gold into EGR and reconversion of EGR into physical gold, no capital gains will be charged. So this is an incentive for conversion of physical gold to electronic gold receipts and vice versa, both of which will be excluded from the ambit of capital gains. The expression electronic gold receipt and vault manager shall have the same meanings which have been assigned to them under the SEBI vault manager regulations. Now, EGRs have been notified as a security under the Security Contract Regulation Act, like equity shares, in order to facilitate the trading on stock exchanges. Otherwise, how do you trade on the stock exchanges? Only securities can be traded. So EGRs have now been notified as a security so that trading on stock exchanges can take place. The cost of acquisition of EGR as per newly inserted section 49(10) on conversion from gold by a vault manager shall be the cost of gold to the assessee. The cost of gold purchased by the assessee will be the cost of acquisition of the EGR. And similarly, cost of acquisition of gold released on reconversion of EGR into gold shall be deemed to be the cost of the EGR in the hands of the assessee, provided the EGR and the gold released against EGR became the property of the assessee as consideration of a transfer referred to in section 47(7)(d). So these amendments have taken place with effect from 1/4/24 and will apply from AY 24/25 on. Next, we come to taxation of market-linked debentures and debt mutual funds. What are market-linked debentures? Let us try to understand. As the very name indicates, these are essentially debentures or debt instruments, but unlike debt instruments, these debentures, these MLDs, or in short, I'm going to refer to them as MLD. So MLDs are linked to a market index or indices such as Nifty 50 or Sensex, so that the returns on these market-linked debentures or MLDs are linked to the marketed indices, and this helps in getting better returns than one would get from investment in a debt mutual fund. So, however, unlike other debt instruments, MLDs enjoyed preferred tax status for many years in terms of holding period and rates of tax. Since these were market linked and these were listed securities, what was happening is that MLDs held for over 1 year and giving rise to capital gains were taxed at a flat rate of 10% till March 2023. Whereas the debt mutual funds were having a holding period of 36 months. So if somebody held the units of debt mutual funds for over 36 months, then only it would be called a long-term capital asset. And in MLDs, there was a holding period of only 12 months. And after 12 months, if you are selling your MLDs, it would be taxed as long-term capital gain at a concessional rate of 10%. So this was the position till March 2023. Now, what has happened is from 1/4/2023, any gains arising on transfer or redemption or maturity of the MLDs will be classified as STCG, irrespective of the holding period and listing status. Whether the holding period is more than 12 months or more than 36 months, still any gains arising on transfer or redemption of MLDs will be treated as short-term capital gain and taxed at the applicable slab rate for the investor, which can be as high as 30% in case of HNIs, plus applicable surcharge and cess. This amendment, by way of insertion of a new section 50AA, brings the much needed parity between MLDs and other standalone debt instruments like non-convertible debentures, bonds, etc. So now what will be the deductions which will be granted from the full value of consideration received on transfer of redemption or maturity or redemption of MLDs? Cost of acquisition of the debenture will be allowed as a deduction, and expenditure incurred wholly and exclusively on transfer, redemption, or maturity. Only these two deductions will be allowed and nothing else. Specified mutual fund means a mutual fund where not more than 35% of the total proceeds are invested in equity shares of domestic companies. So we can say that almost 65% or more than 65% of the total proceeds are invested in debt instruments. So specified mutual fund, we can broadly call them as debt mutual funds also. Percentage of equity shareholding shall be computed with reference to the annual average. Okay, MLD means a security whose underlying principal component is in the form of a debt security. So essentially, these are debt instruments, and where the returns are linked to the market return on other underlying securities or indices. It includes any security classified or regulated by SEBI as MLD. SEBI. By SEBI. The capital gains arising on transfer of MLDs shall be taxed at the applicable slab rate rather than 10%, which was happening earlier. Similarly, capital gains arising on transfer of units of debt mutual funds shall also be taxed as per normal slab rates. No benefit, since these are short-term or treated as short-term capital asset, no benefit of indexation shall be available on transfer of MLDs and DMFs, and no deduction of STD shall be allowed on transfer of MLDs and DMFs, debt mutual funds. This amendment also takes effect from 1/4/24 and shall apply from AY 24/25. The next item is interest claimed as deduction under section 24B or chapter 6A will not form part of cost of acquisition. Basically, this refers to the insertion of a new clause, a new proviso to section 48(2) with effect from 1/4/24 in order to prevent double deduction of interest claimed by taxpayers. What was happening is interest is whenever any house property is acquired on borrowed capital, acquired, renewed, or reconstructed, so interest has to be paid. So such interest is claimed as deduction under section 24B from income chargeable under the head income from house property. And the deduction of interest payable on loan taken for house property is also claimed under chapter 6A, section 80. 80C. 80 also. Yes. So now the interest so paid is also claimed as part of cost of acquisition or cost of improvement while computing capital gains on transfer of the house property. So this was also claimed as a deduction from the full value of consideration, which was received or which accrued as a result of the sale or transfer of the property. So in order to prevent this double deduction, a proviso has been inserted after section 48(2) to the effect that if claim of deduction of interest is made under section 24B or under chapter 6A, then such interest shall not form part of cost of acquisition or cost of improvement for the purpose of computing capital gain. Fair enough. This amendment is effective from 1/4/24 and is applicable from AY 24/25 onwards. Now I'll request Agarwal sir to please take up the remaining items on the.
Okay. Good morning, friends, and good afternoon. Now, another aspect which has acquired attention of our tax-paying public was the amendment made in section 54 and 54F to the effect that there is a capping of investment in the new asset, that is house property, under both sections. So it is creating some sort of complications which we have to understand. But basically, let us understand what section 54 and section 54F provide for. It says that exemption under section 54 is available for investment of long-term capital gains arising on transfer of a residential house. On the other hand, exemption under section 54F is available for investment of net sale consideration arising on transfer of any other long-term capital assets. So we have to understand the difference between the two sections. Section 54 में exemption जो मिलेगा वो आपको capital gains के हिसाब से मिलेगा, कितना कैपिटल गेन्स आया है, कितना कैपिटल गेन्स आपने नए हाउस में इन्वेस्ट किया है. और 54F में जो ओरिजिनल असेट है व्हिच इट इज अदर देन रेजिडेंशियल हाउस, तो उसमें नेट सेल कंसिडरेशन के हिसाब से आपको एग्जाम्पशन मिलेगा. वो कंप्यूट करना पड़ेगा कि सेल कंसिडरेशन से कितना कैपिटल गेन आया है, कितना नेट सेल कंसिडरेशन नए मकान में इन्वेस्ट किया है, उसके प्रोरेटा आपको कितना कैपिटल गेन्स बनता है, उसका एग्जाम्पशन मिलेगा आपको. ठीक है. Such exemption is available when investment of long-term capital gains or sale consideration is made in another residential house under certain conditions laid down in the two sections. So far, there was no limit on amount of investment of long-term capital gains or net sale consideration made in the new residential house. अभी तक कोई ऐसा लिमिट नहीं था. आप भले ही आपने कैपिटल गेन 20 करोड़ का आया है, 20 करोड़ का आपने नए मकान में इन्वेस्ट कर दिया है तो आपको एग्जम्पशन मिलेगा. ऐसे ही अगर 20 करोड़ का नेट सेल कंसिडरेशन उसमें 54F में आपको आया है और वो आपने पूरा का पूरा इन्वेस्ट कर दिया है नए मकान के अंदर, तो आपको पूरा एग्जम्पशन मिलेगा कैपिटल गेन से. ये आज तक की पोजीशन थी. बट गवर्नमेंट रियलाइज दैट सर्टेन बिग पीपल हु आर इन्वेस्टिंग इन luxurious houses, they are claiming exemptions. So in order to ask them, in order to oblige them to pay certain taxes on high value assets which they are disposing, they have put up a capping that a new house can be purchased up to new investment, new house will be only up to rupees 10 crores, which means that under section 54, whenever one will have to calculate how much capital gains will come for the investment of section 10 crore, how much, or under section 54, how much capital gains would be exempted when investment is made up to 10 crores. So this we have to understand. Then an amendment has been made by the Finance Act 2023 in both these provisions so that exemption under these sections will now be limited to rupees 10 crores, even though long-term capital gains or sales consideration may be more than that. Such limit is proposed to prevent claim of huge deductions being made by high net worth assessees by purchasing very expensive residential houses. Thus, where investment in the new house, new asset is more than rupees 10 crore, then it shall be deemed to be rupees 10 crores. And on the balance, capital gain would charge. This amendment is effective from 1/4/2024 and is applicable for a suspended 24-25. Now, how the maximum limit is playing, how we have to work out how it is playing for exemptions, where the new asset, cost of which is restricted to rupees 10 crore, is transferred within a period of 3 years of its purchase or construction, the exemption granted on the basis of cost of rupees 10 crore shall be charged to tax in the year of transfer new asset. मान लीजिए आपने कोई मकान है 15 करोड़ का, जो 15 करोड़ कैपिटल गेन आ रहा है, तो और आपने 15 करोड़ का ही आपने नई एसेट में इन्वेस्ट कर दिया है, आपको एग्जम्पशन केवल 10 करोड़ तक के कैपिटल गेन का ही मिलेगा, बाकी 5 करोड़ आपका कैपिटल गेन इन द ईयर ऑफ ट्रांसफर टैक्स हो जाएगा. दिस वी हैव टू अंडरस्टैंड. For section 54, for example, under section 54, if net sale consideration of transfer house property in financial year 23-24, that is assessment year 24-25, is say rupees 20 crores, and long-term capital gains thereon is rupees 15 crores, and investment in new houses also say rupees 50 crores, then no capital gains would have been charged under the pre-amended provisions. So 15 crore का capital gain आया और 15 करोड़ ही हमने नए मकान में इन्वेस्ट कर दिया, तो कोई भी कैपिटल गेन चार्ज नहीं होगा. अंडर द अमेंडेड प्रोविजंस, हाउएवर, मैक्सिमम इन्वेस्टमेंट इन न्यू एसेट इज कैप्ड एट रुपीज 10 करोड़, देयरफॉर कैपिटल गेन विल बी चार्ज्ड ऑन रुपीज 5 करोड़ अंडर सेक्शन 54. सो यहाँ कैपिटल गेन चार्ज हो रहा है 15, आपका जो 15 करोड़ कैपिटल गेन आया है उसमें से 5 करोड़ का चार्ज हो जाएगा, 10 करोड़ के ऊपर आपको एग्जम्पशन मिलेगा. ठीक है. सिमिलर कैलकुलेशन विल बी डन इफ असेसी डिपॉजिट्स कैपिटल गेन्स अमाउंट इन CGAS अकाउंट. Even if the he deposits entire rupees 15 crores in CGAS account, exemption will be available only to the extent of rupees 10 crore. Balance of rupees 5 crore will be charged to tax in the year of transfer of original asset. So this we have to understand. If only part of amount lying in CGAS account is utilized in purchase or construction of the new asset, and total utilization is less than rupees 10 crore, then balance of capital gains will be charged to tax after expiry of 3 years. 10 करोड़ जमा किया और you are required to invest rupees 10 crores. 5 करोड़ तो पहले साल में टैक्स हो गया, जो ईयर ट्रांसफर. 10 करोड़ आपने CGAS अकाउंट में जमा कर दिया, तो it is expected that you will invest this amount deposit CGAS account within 3 years. अगर आपने 3 साल के अंदर उसको इन्वेस्ट नहीं किया, तो ये 10 करोड़ 3 साल के बाद, 3 साल बाद जो असेसमेंट आएगा उसमें टैक्स हो जाएगा. सिमिलरली अंडर सेक्शन 54F, ये 54 की बात थी. अब 54F में क्या है? where net sale consideration on transfer of long-term capital asset other than residential house is say rupees 15 crores, long-term capital gains arising is say rupees 9 crore, and investment in new house asset is also rupees 15 crore, then LTCG in the year transfer charge to tax will be calculated as under. अब सवाल आया कि पुराने टाइम में क्या था, अनअमेंडेड प्रोविजन में आपका नेट सेल कंसिडरेशन है 15 करोड़ का और नए असेट में आपने 15 करोड़ इन्वेस्ट कर दिया, तो 100% कैपिटल गेन्स का एग्जम्पशन हुआ, पूरा 9 करोड़ का आपको एग्जम्पशन मिल जाएगा, क्योंकि कैपिटल गेन्स 9 करोड़ का है और इन्वेस्टमेंट आपका अगर 15 करोड़ का नए मकान में हुआ है, तो पूरा एग्जम्पशन मिल जाएगा. अब क्या होगा यहाँ पर, ये क्योंकि आपका इन्वेस्टमेंट इज कैप्ड एट रुपीज 10 करोड़, तो अकॉर्डिंगली कैलकुलेशन करके आपको जो होगा, जो 3 करोड़ का आपको प्रोरेटा आपको कैपिटल गेन्स चार्ज हो जाएगा इन द ईयर ऑफ ट्रांसफर ओरिजिनल असेट, और 6 करोड़ का आपको एग्जम्पशन मिलेगा. इफ द न्यू असेट इज ट्रांसफर्ड विद इन 3 years, द बैलेंस ऑफ कैपिटल गेन्स ऑफ रुपीज 6 करोड़ विल बी चार्ज इन द ईयर ऑफ ट्रांसफर. Then if another house property is purchased within 2 years or constructed within 3 years, the amount of capital they exempted, that rupees 6 crore, will be charged in the year of acquisition of another asset. So आपको जितना exemption मिला है वही अगले बार चार्ज होगा. जो पहले चार्ज हो गया है वो खत्म होगी बात. अब जो बैलेंस जो exemption मिला है, सारा कैलकुलेशन सब्सिक्वेंटली उसी के बेसिस पर होने वाला है. तो आपको 6 करोड़ का एग्जम्पशन अगर मिला है और आपने नया मकान विद इन 3 years बेच दिया या 2 years नया और कंस्ट्रक्ट कर लिया, है ना, तब उस 6 करोड़ का उस साल में वो टैक्स हो जाएगा. जो एग्जम्पशन मिला है वो टैक्स हो जाएगा. नहीं, ये वाला हो गया। No. Similar calculation will be done if the net sale consideration is deposited in CGAS account, where the assessee deposits entire net sale consideration of 15 crores in CGAS account. The amount exceeding rupees 10 crores shall not be taken into account, and the exemption exemption will be restricted to only rupees 10 crores. Where investment is made in the new house and also deposits made in CGS account, the amount of investment deposit in excess of rupees 10 crore shall be ignored and exemption will be kept at rupees 10 crores. Exemption limit, that is computation of capital gain, will be done as if your investment is only rupees 10 crores. Now, अब एक उसमें और झगड़ा आता है कॉस्ट ऑफ एक्विजिशन का। ये नए सेट की कॉस्ट क्या होगी? अंडर द प्रेजेंट प्रोविजन सेक्शन 54, इफ एग्जम्पशन फ्रॉम कैपिटल गेन्स is allowed on investment in new asset and such new asset is sold within 3 years of its acquisition, the cost of acquisition shall be taken as nil. This is what section 54 says. Under the new provision of section 54, the cost of the new asset, if transferred within 3 years of acquisition, will not be nil, but will be the amount in respect of which capital gains is charged in the year of transfer or asset. In the example given above, where net sale consideration was rupees 20 crores, capital gains was rupees 15 crores, investment in new asset is rupees 15 crores, and capital gains charged to tax was rupees 5 crores, and capital gains exempted was rupees 10 crore, cost of the new asset will be rupees 5 crores. क्योंकि जितना आपने टैक्स दे दिया है उसके हिसाब से ही नए का आपको मतलब कॉस्ट बनेगा. Under the new provision in section 54, if the new asset is transferred after expiry of 3 years, the cost of the new asset will be rupees 15 crore. एक बार 3 साल निकल गए तो जितना जितना आपका इन्वेस्टमेंट है वही उसका कॉस्ट बनेगा. Under the present provision section 54, F, if the new asset is sold within 3 years of acquisition, amount of capital gains not charged will be taxed in the year of transfer. So also under the new provision, the amount of exemption earlier allowed will be taxed in the year of transfer. Once amount of capital gains is exempted, is taxed, the cost of the new asset will be the cost of which it was purchased, acquired. Once entire capital gains is charged to tax, then the cost of the new asset will be the cost at which it was acquired. Now, maximum limit introduced for quantum so-and-so, where the amount deposited in CGS account is not utilized fully or partially for purchase or construction of new residential house within the specified time, then the unutilized amount to the extent of rupees 10 crore will be charged as capital gains under section 45 in the previous year, in which the period of 3 years from the date of transfer order expires. So these are the about section limit of effect or limit of rupees 10 crores of investment as provided in section 54 and 54F. एक जो ध्यान रखने वाली बात है उससे ये है कि सेक्शन 54 के अंदर आपका जो एग्जम्पशन है वो कैपिटल गेन्स अमाउंट पर डिपेंड करता है और 54F में नेट सेल कंसिडरेशन में डिपेंड करता है. इन्वेस्टमेंट जब उन्होंने 10 करोड़ उन्होंने फिक्स किया है नए मकान के लिए तो कैपिटल गेन्स का कैलकुलेशन उसके हिसाब से होगा. वहां कैपिटल गेन्स 10 करोड़ का कैपिटल गेन्स टैक्स एग्जम्पशन हो जाएगा और यह नेट सेल कंसिडरेशन के हिसाब से जो कैपिटल गेन आएगा वो टैक्स हो जाएगा. दिस व्हाट इट इज. The next item is the cost of acquisition of self-generated intangible assets or any other rights shall be nil. अभी तक क्या था जो सेक्शन 55 के अंदर हमारे पास ये था only in certain cases of intangible assets the cost was provided. In case of several other intangible assets no cost was provided. Since no cost was provided, then the machinery for computation of capital gains would fail, and therefore no capital gain would be charged. So, so amendment has been made that wherever a specific cost to intangible asset is not provided, that it shall be taken as nil. This refers to few significant amendments made by the Finance Act 2023 in the meaning of the expression cost of acquisition and cost of improvement in certain cases as defined in section 55. In the absence of cost of acquisition of certain assets, many legal disputes and controversies have arisen, and the courts have taken the view that for taxability under the head capital gains, there has to be definite cost of acquisition or it should be deemed to be nil under the Act. Since there is no specific provision which states that the cost of such self-generated intangible assets like goodwill is nil, the chargeability of capital gains on transfer of such assets has failed to find favor with the court. So, since computational machinery has failed, and therefore no capital gain would be charged. Now, therefore, to define the term cost of acquisition and cost of improvement of such asset, the provisions section 55(1)(b)(1) and section 55(2)(a) have been amended so as to provide that the cost of improvement or cost of acquisition of a capital asset, being any intangible asset or any other right other than those mentioned in the said subclause or clause, as the case may be, shall be taken as nil for the purposes of computing capital gains. Consequently, as per section 55(1)(b)(1), cost of improvement in relation to a capital asset, being goodwill or any other intangible asset of a business or a right to manufacture, produce, or process any article or thing, or right to carry on any business, profession, or any other right shall be taken to be nil. पहले इनके कोई भी cost of acquisition or cost of improvement नहीं दिया गया था. Therefore, when they used to be transferred, no capital gains was to be charged. But now, after this amendment, capital gains would be charged by taking the cost of improvement or cost of acquisition as nil. Similarly, as per section 55(2)(a), for the purpose of section 48 and 49, cost of acquisition in relation to a capital asset, being goodwill of a business or profession, or a trademark or brand name associated with a business or profession, or any other intangible assets, or a right to manufacture, produce, or process any article or thing, right to carry on any business or profession, or tenancy rights, or stage carriage permits, or loom hours, or any other rights shall be taken to be nil unless such intangible assets or right has been acquired for a price by the assessee or previous owner. तो एक्चुअल जो कॉस्ट अगर है असेसी की या प्रीवियस ओनर की, वो उसका कॉस्ट ऑफ एक्विजिशन बनेगा. अगर कोई भी कॉस्ट, कोई भी प्राइस पेमेंट नहीं की गई है तो इट विल बी टेकन एज निल. So these amendments will take effect from 1/4/2024 and shall accordingly apply in relation to assessment year 24-25 and subsequent assessment years. 22. 22. Now, next topic is determination of cost of acquisition of unit of REIT and INVITs. REIT is Real Estate Investment Trust, and INVIT is Infrastructure Investment Trust. Both are clubbed as business trust. Prior to 1/4/2020, the business trust included only listed REITs and INVITs. And units of listed REIT can be purchased on stock exchange and kept in a demat account. So till 1/4/2020, only listed REITs and INVITs could be traded on stock exchange. With effect from 1/4/2020, even unlisted REITs and INVITs are treated as business trust. The income of the business trust is governed by section 115 UA, read with sections 1023 FC, 1023 FCA, and 1023 FD. Business trusts under the Act are subject to special tax regime. They have been accorded a pass-through status in respect of certain specified income distributed by them, such as rent, only for REIT from properties owned by it, and interest and dividend. So, specified income ये था जो डिस्ट्रीब्यूट हो रहा था वो पास थ्रू स्टेटस में जाता था. इट कुड नॉट बी टैक्स इन द हैंड्स ऑफ बिजनेस ट्रस्ट, बट दे यूज्ड टू बी टैक्स इन द हैंड्स ऑफ द यूनिट होल्डर्स. Interest income or dividend income received by a business trust from a special purpose vehicle is exempt in its hands under section 1023 FC, but it is taxable in the hands of unit holder. Similarly, rental income received from REITs from properties owned by it is exempt in the hands of REIT, but when it is distributed with the unit holders, it is taxed in the hands of unit holders. However, other interest income, other dividend income or rental income from SPVs or other income or capital gains is taxable in the hands of business trust, but is exempt in the hands of unit holders. As per now, question is, what is the cost of acquisition of these units? As per section 55(2)(a)(c), the cost of acquisition of units of a business trust, whether REIT or INVITs, acquired before 1/2/2018 shall be higher of the following: cost of acquisition of such asset and lower of FMB of such asset or full value of consideration received acquired as a result of transfer. So we had to have three factors, three items. What is the cost of acquisition of that asset? And what is FMB? What is the full value consideration? Between FMB and full value consideration, whichever is the lower, is to be compared with cost of acquisition such asset, and whichever is higher will be taken as the cost of acquisition of the business units of business trust. The fair market value has been defined in explanation A in section 52(a)(c). It is in case of listed units, highest price of the units quoted on the stock exchange on 31/1/2018, and where it is not so quoted on 31/1/2018, then highest price when quoted on any day immediately preceding 31/1/2018. In case of unlisted shares, FMB would mean net asset value of such units as on 31/1/2018. Now, certain more points in respect to REIT and INVITs, where a shareholder transfers share of a special purpose vehicle, Indian or of Indian company to a business trust in exchange of units allotted to him by that trust, such transfer is treated as exempt in the hands of shareholder under section 47(17). That is, where shareholder transfers shares of a SPV or Indian company to a business trust in exchange of units allotted to him, then such exchange is not treated as transfer and no capital gain will be charged. Holding period of such units shall include the period for which shares in SPV were held by the assessee. So, since it is not treated as transfer, the holding period will include the holding period for which the shares were held by the assessee. Where, by virtue of section 47(17), units of business trust becomes a property of the unit holder in consideration of transfer of shares to an Indian company in which the business trust hold a controlling interest, the cost of acquisition of the units will be the cost of the shares in SPV held by him as provided in section 49(2)(a)(c). Besides specified income referred to above, business trust also distributes certain amounts to the unit holders, which are generally in the nature of repayment of debt or loan advanced by the business trust. The repayment of loan, being a capital repayment, does not get taxed either in the hands of the lender business trust or in the hands of the unit holders. The Finance Act 2023 has plugged this loophole of double non-taxation by making amendments in provisions relating to capital gains and income from other sources with effect from assessment year 24-25. Expression 1 is added below section 48(2) by Finance Act 2023, and it provides that the cost of acquisition of unit of a business trust shall be reduced and shall be deemed to have always been reduced by any sum which is not taxed either in the hands of the business trust or in the hands of unit holders, either as the specified income referred to in section 1023 FC and 1023 FCA, or as specified sum under section 56 to 10. जो exempt हुआ है वो cost of acquisition का part नहीं बनेगा. This is what this is. Then explanation 2 clarifies that where the cost is determined under section 49 of the Act, applicable in case of exempted transfer, then cost of acquisition shall be reduced by such sum received either before or after the exempted transfer. Any specified sum received by a unit holder from business trust other than those in the nature of specified income taxable in the hands of a unit holder or other income taxable in the hands of the trust will be deemed to be an income in the hands of the unit holder taxable under the head income from other sources, section 56 to 12. Then further, any distribution received from business trust for redemption of units in excess of cost of acquisition will be taxable under the head income from other sources instead of capital gains. Now, these are all about topics which were assigned to us for today's webinar, and I am really very grateful to all my friends who have very carefully and very attentively have listened to us without any problem, without any issue. Now, at the end, I would like to introduce that we have authored one book, the law relating to capital gains. This book has been written by us in question answer form, so that it answers most of the questions that arise in the minds when a capital asset is transferred by the person. This book contains about 1,200 questions and their answers. It is not simple question answer. It is very detailed question answers. It is all about, it covers very long paragraphs, and they are based on various court decisions. It refers to about 3,000 case laws, and it covers about 650 topics and has 55 chapters. So, some specific topics have been covered by us, such as setup of capital gains, then non-resident taxation, alternative tax regimes, capital gains and business trust, capital gains under IFST, capital gains under international taxation, and it covers material as amended by Finance Act 2023. Each chapter, there are 55 chapters, as I've said. Each chapter is starts with introduction, then provision, then amendments and circulars, the analysis of provision, then frequently asked questions, and thereafter summary and checkpoints for tax planning. That summary gives some very concise and precise points that emerge from the entire discussion made in the chapter. So this is all about, I hope, when you go through this book, it will help you immensely, and it is like a treatise for you. Now, for example, chapter 3 gives brief about capital asset. Section then there is scope of capital gains as section 45. Then there are exempted transfers as per section 47. There is a different chapter for slump sale. Then and detailed discussion about section 50C, and there is comparison of section 55A and section 41, 42A. Then exemptions under section 54, 54F, business queries. And so this book will be helpful for all the three kinds of our readers. One, who is interested to understand the law. Second, who wants to know the salient points, features of particular section, and those who want to answer to their questions. So all the material of one topic is placed at one place, which will be helpful for you. There are a large reference to case laws, and it has been done in such a manner that, for one topic, we have searched all the case laws, and then they have united like a garland, and all those, so that when you read the questions, read the answers, you will find the reference to so many case laws, but it will appear to as a one full paragraph without any break. So, we hope that when you go through this book, it will be of immense help to everyone. Now, we want that there is any query in the mind of any listener, any one of the audience, we are welcome. So, thank you all. It's almost like, another, humorous note that when his daughter, in case of...
There are few questions. Yes, sir. Thank you, sir.
Yes.
Sir, actually, there are few questions appearing in the Q&A session. Should
Okay.
I read it? Should I read them for you?
Yes.
Yeah, there is a question from an anonymous attendee. Capital gains invested for construction of residential flat, but builder
Okay.
note made section 194 1A TDS deduction in the respective financial year in which payments have been made periodically. TDS is finally made at one go when final installment has made to the builder. Kindly clarify, sir.
No, इसका जो क्वेश्चन है ना, आप मेरे को टेक्स्ट भेजिए, इसको टेक्स्ट भेजिएगा.
So that text is available in Q&A at your side also.
Can I read the text?
Yeah, sure.
Where? Huh? Okay. ये कहाँ है? क्वेश्चंस कहाँ है मैडम? क्वेश्चन कहाँ है मैडम?
Beside the participant.
What will happen for the interest claim on earlier, whether can be capitalized? Okay. One question is, what will happen for the interest claim in earlier years, whether can be capitalized? No, question of capitalization will come only when it is a business income. So far as house property is concerned, if you are paying earlier, before this amendment, it became the part of the cost of acquisition. But then after amendment, now once you are claiming deduction in 24B or chapter 6A, now it will be excluded. So when you are thinking of capitalization, it will not be available. Capitalization means that it is reduced from the cost of acquisition. Okay. Whether exemption of rupees 10 crore each will be available for section 54 and 54F. In other words, total rupees 20 crore exemption can be claimed in a particular in other words, total rupees 20 crores exemption can be claimed in a particular assessment year under both the sections. Now, suppose a person has sold a long-term capital asset other than residential house and also sold residential house, and both put together, he has invested in a house which is costing, say 25 crores something, or say 20 crores. So certainly under section 54 on sale of residential house, he will get exemption of 10 up to 10 crores capital gains, and under section 54F, with respect to investment of sale consideration, he will get exemption of capital gains. Yes, it's possible. Next. Case of joint development agreement accessibility status, lump sum corpus hardship allowance, monthly rental payment in development period extra year received after development. See, it will depend on the detailed facts of the case. It is very difficult. On this basis, we can say it is possible, it is also not possible. No, because only on the basis that we cannot say that in every case such allowance will be available. It depends on terms of agreement, how it is being drafted, and so we have to examine the entire facts of the case and agreement. That it is capital gain invested for construction residential flat, but builder not made section 194 IA TDS deduction in respect of financial year in which payment has been made, but periodically TDS is finally made at one go when final installment has been made to the builder. Kindly clarify, sir. See, if TDS is required to be made periodically, then it is a fault of the builder. Whatever liability has to come, it will fall on the builder. So far as you are concerned, you are going to get the deduction of entire TDS made, whether in one go or whether in installment. So it's very clear. So your tax is deducted, you are going to get credit for it. But so far builder is concerned, if he's as per law required to make deduction periodically, he has not done it, then it is for him to make the payment of interest and penalty. Whether the amount invested in CGS can be used for making payment of TDS on purchase of new property. Yes, TDS is nothing. I mean, it's a part of the payment. If you make the payment out of this, it is, I mean, part of your investment. So there is no issue. There should not be any question that you will not get credit of it. You will. Whether the amount invested in CGS can be used for making payment of TDS or purchase. Yes, I've made it. What is the tax treatment of issue of bonus debentures by a listed company, both the time of issue and redemption? Now, I mean, it requires a lot of discussion and research of case laws. So immediately we will not be able to, I mean, answer this thing, how it is to be done. And it is a question, I mean, you send to my mail, we will work out and give you the answer. Amount reinvested for construction of residential house within 3 years for exemption under section 54F, but the amount was not deposited in the CGS with the time limit. See, ultimately, if you are able to construct a house within the 3 years, then there are several case laws which says that there are two conditions. One is that you have to deposit CGS account. Other is you construct a house within 3 years. If you are doing within 3 years, then even if you may not have deposited a CGS account, courts have said that, I mean, you will going to get exemption. But there are other authorities which say that you must necessarily deposit within the time under section 139(4). So when we combine the two provisions, that is to be deposited by the period of 139(4) and within 3 years, then preference should be given by you to make investment within the period provided under section 139(4). But even in case, I mean, you have a lot of authorities. You can read into my book that there are several authorities which say that if you have within 3 years constructed a house, even though you may not have deposited in CGS account, you are going to get exemption. Next question. Can 54 and 54F be claimed for investment made in joint property where one has capital gain on house property, other? Yes, I have already said, yes, you will get. Because exemption is to be given on the sale of original asset and investment out of the capital gains on net sale consideration. So it is not that even if, I mean, when you sell two properties and invest in one, you are going to get exemption in both the cases. So here also, even if limit is of 10 crores, then you are selling two properties on which capital gains is more than 10 crores and you invest into one, you are going to get exemption for both. Next question. What should we do if we claim deduction that capital gains amount has been deposited in capital gains scheme account, but in actual we have never deposited account? ये तो थोड़ा सा गड़बड़ मामला है भाई. आप क्लेम करते हो कि साहब ने जमा कर दिया है, लेकिन वहां जमा नहीं किया है, तो इट मींस बस वन डिपार्टमेंट फाइंड इट, तो वो एग्जाम्पशन देगा भी नहीं और पेनल्टी भी लगाएगा भाई. तो ये तो सब वो एप्रिशिएट नहीं हो सकता. Can we apply for appeal or rectification for the exemption claim, but in actual was not eligible for it between order by AO has not issued? Can we apply for appeal or rectification for the exemption claim, but in actual was not eligible for it? See, doesn't matter. I mean, even if when your case was before the AO, at that time, certain conditions were not fulfilled. Subsequently, when you are coming in appeal, conditions are fulfilled. The condition has to relate back to the sale of original asset. And if you satisfy that all the conditions which were not satisfied during the period when your case was before AO, but they are satisfied subsequently, and there is no illegality, irregularity in those satisfaction of the conditions, then certainly you are going to get exemption when you are in appeal. Because these exemptions are, in fact, beneficial provisions, and if it is possible to give you exemption, they will give you exemption.
They were not eligible. They're saying, actually, we are not eligible.
Can we apply for appeal exemption?
To withdraw this.
But it was actually not eligible for it between order by
AO has not been issued. Order by AO is yet to be passed. They want to.
So all depends. All depends. I mean, if you have made a claim, you can file the revised return and say that, I mean, in case you feel that, I mean, conditions are not satisfied, you are not eligible for getting exemption, then certainly you can withdraw it and write a letter. You can save yourself penalty. And you have to explain under what conditions, in fact, you made this claim. And how do you feel that now it is not necessary to make claim and to rectify it. You have to show your bona fide in making claim earlier, which was wrong. The next question is, paid ₹4 lakh interest on home loan in self-occupied flat. ₹2 lakhs was claimed for 5 years. After that, sold flat, want to claim ₹2 lakhs in each year foregone. Acquisition cost. Can I do because no double deduction? No. Paid ₹4 lakhs interest on house loan in self account. ₹2 lakh was claimed for 5 years. Something is wrong, brother. Yet to clarify, you write in detail to my mail. One should not go for any wrong claims. We invite trouble from the department. Can a residential house bought be set off against 2 capital gains spread over 2 assessment years? See, ultimately, you have to satisfy the condition of 2 years of purchase or 3 years of construction from both. Understand now? Now, suppose, it is possible that when you sell one house and you construct one floor on that, you take it as, half constructed. Once it is constructed to that extent, you are going to get exemption on the first capital asset that you've sold. When in the next year you are selling another capital asset, you want to make addition on that, you construct new house over that, then it is possible for you to get exemption for the second also. Because you have to be within time limit. Ultimately, everything for exemption depends upon the time limit within which investment has to be made. Next, who shall be eligible for payment of income tax in case where properties are being transferred through power of attorney and sale consideration also being received? We have a recent judgment that it has to be taxed in the hands of the original owner, not in the hands of POA. You can search for the judgments. Can capital gains on sale of properties eligible for development of flats or restricted to only one house? No. Development, again, it depends what kind of development you are making. That is, if it is some sort of renovation type of thing, some sort of, this thing, unless you show there is a construction, how construction can be shown? You have to have permission from the relevant authority that you are constructing something either on the land or over the house, or for which you have purchased the right to construct second floor or first floor, like that. So you have to prove the construction.
One residential house.
Only one residential.
Deduction will be
limited to one residential house. It is possible when in sale one capital asset, you construct a house, you sell next year another capital asset, and over that you construct another house, and for which you complete all the formalities with municipal corporations for construction and for permission, etc. If that is done, then certainly you have a case.